Okay, hello everybody, and welcome to the next installment of the Butte County Library REACH programs, financial wellness and financial literacy workshops. So today we're going to talk about long-term investing and how to kind of think about and structure a long-term investment portfolio. Previously, we've talked about retirement planning in one of our last videos. And how to know about how much you need for retirement and how to kind of plan the dollar amounts that you're going to need there. And so if you haven't seen that one, I highly recommend you go watch that one first, just as kind of like a baseline of thinking about retirement planning. This is going to be more about how do we set up our portfolio, what kind of investments do we look at inside that portfolio when we're generally thinking about retirement planning, although there are other kinds of long-term investing that we might do besides retirement. It's just for most people, when we talk about long-term investing, we're usually thinking about retirement planning, but there are a number of other things. For example, education savings. If you have a young child who maybe they're 15 years from school, they're maybe 3 years old or something, and so you're thinking about saving up for college, that might be a long-term investment plan that you might have in order to save up for them to go to school. And with the way that school prices have gone up over the past couple decades, I expect school to be pretty expensive in the next couple decades as well. So that might be a long-term investing strategy that's not retirement, for example. But I'm going to kind of have a bias towards talking about retirement planning for this presentation, just because that's what most people think about. And I'm just kind of playing to the crowd a little bit here. So let's get into it. My name is Jacob Arbogast. I'm the director of the Financial Wellness Clinic at CSU Chico. And I talk with people about investing and budgeting and savings and debt repayment and all kinds of financial planning topics every day. And so this workshop is going to be about long-term investing. So first off, this is a presentation for Butte County Library's REACH program, and the REACH program is all about helping to bring economic empowerment and financial literacy and business resources to the Butte County community. And so if you are interested in any topics related to any of that, if you're an entrepreneur or you're looking for trying to better your career, or you're looking for financial wellness or economic empowerment information, all of that is available at the Butte County Library's website. And you can search for the REACH calendar to see all the different topics that we cover. In the past, at least for my section of the financial literacy topics, we've covered things like how to work with your kids and teach your kids about money topics, how to plan for retirement, how to plan for your estate, which is when you leave things to your heirs, how to set up a budget, how to pay off debts, things about credit scores. We've talked about all those kinds of topics in the past, and all of our presentations have been recorded and are available, and you can watch them through the YouTube channel or directly on the website. They're embedded on the website there as well. So I highly recommend you go check some of those out. They are great. There's a whole host of people who run these different workshops. It's not just me. There's a lot of different resources there for everybody. And so that's what this program is about. And today we're going to talk about long-term investing. Before I do that, though, I do need to have a disclaimer. So I used to be a financial planner. I was a financial planner for a number of years before I started working at Chico State. And so anytime I talk to people about investing, I need to be careful, because I need to be very clear that I am not making specific investment recommendations to you, the listener. I don't know you. This is a general presentation for the public, right? This is available to anyone. It's designed to be for Butte County, but it's really going to be on the internet, so anyone can watch it. And so I don't know you, and I don't know your specific situation, and so I'm not recommending any specific investment to you at all. This is purely for educational purposes. And so when I talk about investing, I need to say that you should talk to an investment professional yourself. You should you should invest for your specific needs. I don't know your specific needs. You are not my client, and the presentation that I'm giving here is not does not establish any kind of financial planner-client relationship. So I just want to make sure everyone's very clear on that. Every investment, all investments, even the ones that say they're risk-free, all investments involve some sort of risk. And so I want you to know that any investment you're going to be in, if there's any uncertainty at all, then there's some risk there, and you could possibly lose money. And so be aware of that. Even whatever I say at all in this presentation, I'm going to be very clear about that this is educational, but no matter what I say, this statement is going to hold true. So just be aware of that, please. Thank you. Okay, so we're going to talk about long-term investing. What is long-term, right? How do you define long-term? So for the purposes of this presentation, I'm going to be considering long-term to be 10 years or more in the future. So if you're going to save for something in the future that is 10 years away from today or longer, then we're going to consider that long term. If it's shorter than 10 years from the future, then you don't necessarily need to say it's short term, but it's just not long term. And so there's going to be different investment strategies or different savings strategies depending on whether you're looking at the long term or the short term. And why do I say 10 years? Well, it has to do with investment returns and how they performed historically. I'll show you that in just a minute. I'll show you what the actual stock market, S&P 500 usually is what we refer to when we talk about the stock market. I'll show you how that's performed historically, and we'll see why 10 years just is kind of the default rule that we use for long term. Now, if you're looking at 9 years from now, that's kind of one of those on the fence scenarios, and you can decide for yourself, or you might want to talk to an investment professional about your specific needs. But for the purposes of this presentation, we're going to stick with the 10-year time frame as being long term. So if you have a goal that's less than 10 years away, investing in stocks or other risky assets might not be the right idea for you, but it really depends on what it is. There's some types of places that you can put your money that has very little risk and might work for a short-term investment, something like a bank CD, where the bank will guarantee you a certain return so long as you keep your money in their savings account, in their CD. That might work for a short-term investment because it's insured, so there's essentially no risk there. There's not really any uncertainty. The only risk that might exist would be like interest rate risk if they change their rates or something like that. But that might work for short-term investments. For long-term investments, we might look at some other types of investment choices, and we'll do that now. So first off, when we're looking at long-term investing, more than 10 years away from now, we need to start with why are we looking at our investments? And so we're going to first think about, I want to invest. Why do I want to invest? What is the target that I'm aiming for? Some examples might be retirement, right? I said early on, I'm going to kind of have a bias towards talking about retirement in this presentation. Retirement savings is one of the most common reasons anyone's going to invest for anything, right? It's because you need to save up so that you can stop working someday. We all want to, even those of us, I love my job, but someday I'd like to retire so that I just can, lay around the couch no, not really. I'll probably do some fun stuff when I'm retired, but eventually I want to be retired. Or maybe I want to save for education, college education for my kids, maybe myself, any kind of reason where I might need to save up money for a very large purchase in the future. Or some dream I have. Maybe it's my dream to own some kind of mansion or something, or maybe it's my dream to move to some more expensive place to live, or maybe it's my dream. I know somebody who works on Wall Street. His dream is to quit his job and sail around the world, and he's actually pretty close to it. He saved up quite a bit of money, and he has a boat, and so his plan is to actually sail around the world. And so that's something where he needed to save up long-term for. It took him more than 10 years to put all the plans together and to get the boat and to get the plans and all that. So those are things that, I might want to save for the future over the long term. After I have my why, what am I saving for? I need to think about how am I going to get there? And so for retirement, a 401k, an IRA, a SEP, which is a self-employed, it's actually simplified employee pension plan, but it's for mostly self-employed or small businesses. Those are all retirement plans that I could use to save for retirement. And even then, there's other, within the 401k or IRA, there's traditional and Roth investment accounts as well. And so we've had a presentation on retirement planning where we talked about the difference between Roth and traditional plans. Go back and watch that one if you want a little more detail. But basically, these are some ways that I could save for my retirement plan. Or maybe my goal is to save up for my children's education. I have a young child. He's 4. He'll be 4 next week. He'll be 4 soon, and he has an education savings account. And so I don't have one of these ones. I have just a separate savings account that's not any of these kinds. But one way to save for education is with a 529 plan. It's a very popular way to do it. Each state has their own 529 savings plan that you can use. You could do a Coverdell educational savings account. That's another kind. That's a little bit like an investment account. It's kind of like an IRA, but for education. You could do a UTMA, which is a Uniform Transfer to Minors account. That would be one where you actually gift the funds to the child and then manage it on their behalf. There's all kinds of different ways to save for education. But once you know that that's your goal, then you can outline the kind of account that you're going to use. And even if you have some other dream that's not necessarily retirement or education, you might use a taxable account, you might just use your regular bank savings, you might just pay for it monthly when you get paid or bi-weekly with your cash flow. There's a lot of different ways to save for long-term investments or long-term goals. And you need to go kind of in order of what am I saving for? Why do I want that? Then how do I do it, right? So let's look at some historical performance. So let's say, I'm gonna go back real quick and I'm gonna say, okay, let's go from the idea that I'm saving for retirement. I know that I wanna do this within my IRA. Maybe I work for an employer that provides a 401k or a 403b, but maybe I have that separate, and they're matching my contributions, and I'm just letting that go. And separately on my own, I want to save in an IRA so that I can supplement my retirement plan. That's absolutely fine. Lots and lots of people do that. That's extremely common to do. And so let's say I want to save in my IRA. I have a traditional IRA. I make pre-tax contributions to my traditional IRA. And then when I retire, I'll take money out of it, but I need to make sure I have enough money in the future. So we'll pretend that I'm young enough that I'm more than 10 years away from retirement. We say, okay, I'm going to go buy some stocks, for example. Your retirement account does not have to always have stocks in it. There can be other kinds of investments, but we're going to stick with stocks for right now, just as a kind of common example that a lot of people use. This link right here goes to a website called TradingView. I'm going to open it. I'm going to take a look at TradingView, and TradingView is just it's a website that a lot of investment people use. Nope, it's not opening. Let's try this out here. Oh, my computer is just very slow is all. So TradingView is a website that investors use to look at charts, stock charts. If you ever see on the news when the stock market is ticking up and down and there's a graph of it, people use TradingView to a little bit frustrating how slow this is going. So we'll just go to tradingview.com. And then so in TradingView, I'm going to go to the S&P 500. And just let's look at the S&P 500. It'll let me. There we go. Okay, so the S&P 500 today, just today alone, is not doing too great because the inflation numbers came out this morning and they were higher than expected. And so the market goes down quite a bit because of that. But we're going to ignore that. Just today doesn't really matter. When we're looking for long-term investing, each individual day really doesn't become relevant because we're going to have thousands of days, right? So tens of thousands, even if we're looking for more than 10 years. Maybe we have 20 or 30 or 40 years of saving for retirement if you're a younger person. And so we can, let me move my, there we go, move that out of the way. And let's look at the stock market over years. This is over decades, right? This is looking at 1970 till today, has this really big curve, right? This is exponential growth that's going on here. But you can see that there were some times where the market went down, right? And we can see that there's some red bars and some big dips. And these are all historic times where there was some negative thing that happened. And so this first big hump right here is in the year 2000, and that was the dot-com bubble. Some of us probably remember that, but the dot-com bubble is when technology stocks did really well for a little bit and then kind of came back down. And there's a lot of historic context around that, which I'm not going to get into, but it came down, the bubble burst, so to speak, and so the market crashed. And it bottomed out around 2002, 2003. And then it came back up again. So from that bottom, rally happened. And then prior to the Great Recession in 2007, 2008, the market rallied back up and then crashed again. And that was the Great Recession. And that was a lot of housing and mortgage-backed securities and those kinds of things tend to, or did bring the market down. And that was a kind of a global recession that happened. And then we've rallied since then. And since then, the market has been doing really well, although there were some little dips and some breathers. There was in 2016, 2015, there was another one in 2020, and of course that would have been COVID. And so we've had, kind of a run up, and then just lately, you can see here we've been down quite a bit, and that's all the things going on in 2022 global, conflict and those kinds of things. So what I want to highlight here is that at any big hump, even if I were to zoom in and look at some of the, let's go the other way. If I were to zoom in and look at some of these other moves that happened, so here would be 1987, there was a big dip and it came back. By 1989, the market was back to where it was before the 87 dip. And if we scroll back down here, you can see in 72, we had the oil embargo that happened in the 70s, and we had stagflation. And so from 72 to about 80, so that's been about 8 years, the market was below its peak, the peak that it hit in 72. But waiting 8 years, and the reason I say 10 years is going to be our long-term horizon is because there is not, for the S&P 500 at least, there is not a time period greater than 10 years where the market has been down. And so that 8 years time span from 72 to 80 was one. And then from the peak of the dot-com bubble to the peak of the Great Recession right before the Great Recession happened was 7 years, from 2000 to 2007, and then a dip. And then after the 2007 dip, let's say you bought at the worst possible time. You bought at the very high, and then it immediately crashed after you bought it. It would have taken you 7 years to recover there. And it would have taken you from 2007 to 2013, so about 6 years to recover from the Great Recession. And then since then, the market's been up quite a bit. But even if you bought right at the peak before the COVID collapse, it came back by October, right? So by the end of that year, you would have been fine. So the reason I use 10-year time horizon is because with the S&P 500, historically, we've never had a 10-year period where the market has been down for longer than 10 years. So if you're willing to save money for the long term, 10 years historically tends to be a good time frame to where you're not likely to lose money. Now, the future can be anything, right? Nobody really knows. Nobody has a crystal ball. And so it may be the case that the market is currently kind of coming down now. And if it comes down here and just stays down for more than 10 years, it could be different than we've ever seen historically. But as of now, that doesn't seem to be the case. I do want to show you one other one though, and then the NASDAQ. The NASDAQ is the investment index, the index for tech stocks, and technology companies specifically are within the NASDAQ. And so this doesn't have other, construction or agriculture or those kinds of things. It's just technology companies. But it is a pretty commonly quoted index when you look at like investment news and market and economic news and stuff. And so the NASDAQ had a really good time in the dot-com bubble because the NASDAQ is tech stocks and dot-com stocks are tech stocks. And so the NASDAQ did really, really well when the dot-com bubble went up and was going up, but it also did really badly afterwards. And it never really, it did eventually, but for a long, long time, it didn't really recover. And so it took until let me move this out of the way. It took until 2015 for it to get back to the point that it was at the top of the dot-com bubble. So that was 15 years. So I said earlier, there's not a 10-year time period for the S&P 500, and the S&P 500 represents the 500 largest companies in the United States. The NASDAQ represents technology stocks in general, and I don't remember how many, but I'm going to guess there's about 3,000 maybe stocks on the NASDAQ. I'm not 100% sure, but maybe there's something like that. And so the NASDAQ has had time periods where it has been down for longer than 10 years. And the idea here is S&P 500 is more diversified. Diversification means that you have lots of different kinds of investments and you're not putting, so to speak, all your eggs in one basket, right? And so with the NASDAQ, you're putting all of your eggs in the technology basket. And when technology does well, like it has recently, except for the like 2020 so far this year, but up until the start, 2022, up until the start of 2022, the NASDAQ had done great, but you have all your eggs in one basket again. And so it came down quite a bit recently. And if you had everything in the NASDAQ in 2000, you would have lost money and it would have taken you 15 years to get back to where you started. So if you can have something a little more broad, I'll look at some different types of investments that are more broad in just a minute, but that's an example of one that's less broad because the NASDAQ is all technology. Let's see if we can get back to. There we go. Okay. So make sure we got that working. Okay, so so that was the historic performance of the S&P 500. So the S&P 500 is the biggest 500 stocks in the United States. The Dow Jones is the biggest 30, I think it's actually 32 now, but biggest 30 or so stocks in the United States. So those are just the largest ones. And then the NASDAQ isn't the largest, it's just technology. So those are different kinds of investments, but you can, for long-term investing, you can invest in things other than stocks. You can invest in real estate, you can invest in commodities, you can invest in bonds. There's a lot of different investments. I'll show you, these are all called asset classes. I'll show you some different ones in just a minute. But diversification is the key here for long-term investing. Why do we want diversification? We want lots of different choices because if something bad happens to one, we have all the other ones that can still do okay. One of the examples I use with my students at school at Chico State is if there was, let's say there was some disease that occurred that only affected coffee bean plants, and it ended up being a global pandemic of just coffee bean plants. And it turns out that it ends up ruining the coffee industry. Well, that would probably hurt Starbucks a lot, right? Starbucks would have a big problem if coffee bean plants had some pandemic type disease for coffee beans. Would it hurt Microsoft? No, probably not as much. I mean, sure, the employees of Microsoft probably like their coffee and they might be less productive because they're less caffeinated, but in general, that won't affect Microsoft's sales and it won't affect Microsoft's performance nearly as much as it would Starbucks. And so I want to have investments in different industries, different risk profiles, different possible exposures to risk, so that if something bad happens to one of them, one type of investment, my other ones will still be okay. And so I won't lose everything all at once. In the finance world and the academic world, we call that unique risk. If I have unique risk, that means I'm investing in like something really specific that could be bad, and I'm not diversified enough. I'm too cloistered, and so I might want to expand out and invest in other things. And so that example that I have about coffee beans is within stocks, right? I could buy Starbucks and Microsoft stock, and I'm a little bit diversified. But if I also buy Caterpillar, and I also buy Netflix, and I also buy I don't know, but you get the point, right? Lots of different other stocks, Home Depot, maybe something like that. Now all of a sudden I have a lot of different industries in my portfolio. And so now I have a lot less exposure to any one specific issue that happens. And so in my long-term retirement planning, I don't necessarily always have to have stocks. I could buy other types of things. Within the economy I think there's 11 different sectors, and you can see them here. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. Yep, there's 11 different sectors here: utilities, real estate, materials, information technology. The consumer discretionary would be things like retailers, like a Walmart and Target kind of thing. Consumer staples would be more like food products, that kind of stuff. And so consumer staples are things that people have to buy even if the economy is not doing very well, and consumer discretionary are the kinds of things that people usually cut out as fast as they can when the economy starts doing poorly. But when the economy does really well, consumer discretionary tends to do really well too, because people tend to spend more when they have more discretionary money. So these are different sectors, and you might want to buy stocks, or you might want to buy investments that are in all these different sectors, or a little bit in each sector, so that you have more diversification. In addition to stocks, we have different asset classes, and the different asset classes allow you to invest in things besides stocks. And some of the most common ones would be bonds, commodities, currencies, and real estate. And so I'm gonna go look at some of these real quick, and we'll just pick a few. I think commodities tends to be really interesting, although you might not want to buy futures for your retirement account. But we'll look at that real quick. Stocks and bonds tend to be the most common. And I think real estate, just me personally, I think real estate is a good idea, although real estate pricing has tended to go up quite a bit in the most recent months, and so it may be prohibitively expensive for a lot of people. But I think in the long term, if you're going to look over, investing for 10 years or more, real estate might be a good component to include in your investments. Let's look at bonds first, just so that we have. Oh, I can't use this link, so we're just gonna we'll go back to here, and we'll do FINRA, Morningstar, and they have a bond search page. Okay, so I could search for bonds using so this is just a website you can use, FINRA, which is the Financial Industry Regulatory Authority, and then Morningstar, which is a screener, a company that does investment research. They work together. And so I could say, let's go look at Microsoft and bonds and show results. And then you're going to want me to agree that this is for educational purposes only, not making any investment recommendations. And so Microsoft has bonds, and a bond is a loan, and you can loan money to Microsoft and they will pay you back with interest. And so you can see on here, there's a lot of different loans that Microsoft is willing to borrow from. They put out essentially like a call. I mean, it's a loan, it's a bond that you purchase the bond, and that's loaning money to Microsoft. And so a corporate bond, I could loan to them. This price here is 115.426, and bonds are priced in, this is actually a percentage, and bonds are priced in thousands. So 115% of 1,000 means $1,150. It's actually $1,154.26 to purchase one bond for Microsoft, but they'll pay me 5.2% interest annually from now until June of 2039. And so I could do that if I wanted to. Let's go open it real quick. And we'll go look at, this is one particular bond, and you can do this for any company. I searched Microsoft, but you could go search Amazon and Home Depot and Lowe's and Caterpillar and JCPenney's and whatever else. Actually, I don't know if JCPenney has bonds or not, but you could go search for any company you want and see what bonds exist for them. And so if I wanted to loan money to Microsoft and receive interest on my loan, I can do that just like a bank loans money to people and gets paid back with interest. You can be the bank for Microsoft. Now, the riskiness here, because every investment involves risk, is that Microsoft may not pay you. Microsoft could file for bankruptcy, and they could decide, hey, we can't afford our debt and we're going to file for bankruptcy and we're not going to pay back our loan. The bank has that same risk when they lend to you, right? Now, you know, hey, I'm not going to file for bankruptcy. I'm really good with my money. And Microsoft says the same thing to themselves. But we don't know that about them, and they don't know, the bank doesn't know about us. Now, is Microsoft likely to file for bankruptcy in the next 10 years? No, they're a gigantic company with lots and lots of cash, and they're probably pretty financially strong. And so it's very unlikely to happen, but could it? Yes, it could happen. Who knows what could happen in the next few years? Microsoft could have some sort of natural disaster that affects all of their locations or something. I don't know. I have no idea. Political turmoil, there could be all kinds of things, and no one really knows. And so there is some risk there, but it is an option. And so a lot of people tend to get bonds in their retirement accounts because they can generate an interest return. They get paid regularly. In this case, this is a semi-annual. Let me see if it lists on here. I just know that this is, semi-annual. It's a semi-annual bond, which means they pay every 6 months. And so every 6 months, you get some income from this bond up until 2039, and they'll keep paying you for as long as, until they pay off their debt. And at the end, they'll pay you back the whole principal as well. And so that's kind of nice. You can go look at the prospectus, you can see the rules of the bond and how they decide whether or not they're going to file for bankruptcy. But for Microsoft, you might not worry about that, but some companies you might worry. There's some companies that aren't very financially stable, but they'll probably be charged a higher interest rate, right? Because they're less credit worthy, just like a person might be less credit worthy with a low credit score, and they might have to pay more interest. A company might have a low credit score and have to pay more interest as well. So that's one thing that you could look at for your retirement account. You could also look at commodities or currencies or real estate. We'll look at commodities real quick just because I think it's interesting. CME Group is so the Chicago Mercantile Exchange is CME. And so CME Group is the company that owns the Chicago Mercantile Exchange. There's other ones too. The Intercontinental Exchange is called ICE, ICE. And so you can go look on here. So let's go look at, if I wanted to buy precious metals, which would be gold and silver and platinum and palladium, I could go buy gold for my retirement account. Not really a long-term investment strategy for a lot of people, but it is possible, and you could do that. And so currently gold, as of right now when I'm recording this, is priced at $18.75 an ounce. It's gone up a little bit today, but the market's going down and people are worried about inflation. So people tend to move towards gold and move towards other types of investments when inflation is really high. So that's made gold go up a little bit today. And so you can see you could buy, for every futures contract you purchase, it's the value of 100 troy ounces. And so this is $18.75 per ounce, which means if you bought this, it would cost you $187,500 to purchase one gold future. It's a lot of money, but if it's in your retirement account, maybe you could do that. This is just an option. And the only reason I'm showing you these is to show that there are other kinds of investments besides stocks that you could put in your retirement account. And so these are just some of the asset classes. Of course, you could do real estate. I have a good friend of mine who buys real estate in other states, not in California, because California prices are so high. But one of the things he looks at for his real estate investments is what's called the cap rate. And the cap rate is how much do you get paid in rental compared to what does it cost to purchase the property. And so in California, you can definitely charge higher rates for rents if you own a property, but it costs a lot of money to buy property in California. My friend owns property in Ohio and Arizona, where property values tend to be cheaper than California, but also rents tend to be less than in California as well. The difference is that the rents tend to be not significantly less, whereas the purchase price of the property is significantly less. And so he ends up getting a higher return on his investment by looking in other states. And so you could do something like that as well. Purchasing real estate generally requires some sort of debt. We call that leverage in the finance world. And if you're going to do investing using debt, there's a lot more risk involved there. And so that's another one of those areas where you really should talk to an investment professional for your specific situation before you just dive in. But those are all things that could be in your long-term investment portfolio. How do I go about buying these? Well, I usually advise my clients that an ETF or a mutual fund is the easiest way to get started. And so if we go, I have this pulled up already, Yahoo Finance here. If we go to Yahoo Finance, we can search for an ETF or a mutual fund. An ETF stands for Exchange Traded Fund. A mutual fund isn't an acronym, it's just a mutual fund. But what an ETF, an exchange traded fund, or a mutual fund is that they are a pre-built portfolio that you can purchase and not have to build it yourself. And so there's a few different ways to go about doing that, but we want to look for a certain category. So if I go look at this category here, oh, sorry, let me first say, I went to Yahoo Finance because that's a publicly available website that anybody can use. I have no affiliation with Yahoo Finance. I just wanted to try to find something that you at home could go do this yourself, and Yahoo is publicly available, so you can do this. And so in Yahoo Finance, I went to ETF Screener. And a screener is just a search tool that you can find. And so over here, I haven't put in any rules yet, so it says 0 results. But once I start putting in certain categories and certain things that I'm searching for, it'll tell me how many ETFs meet that result. So there's a lot of different choices here, and I could do all kinds of different things. So these ones that say muni, that stands for municipal, and that would be like government-related debt usually. There's all kinds of different things. Target date fund, which is a really convenient way. So let's say target date 2055. So I'm going to check the box for that. There are no target date 2055s on that exchange. Let's remove that exchange. And then let's change this to a different target date, 2050. See how many, 2045. We'll start adding a few and see if there's any target date funds that come in here all of a sudden once we start. No, it doesn't look like that's the case. So let's just change it to something else. Real estate fund. There we go. There's 38 real estate funds. Okay, so let's say I didn't have enough money that I could purchase an actual property. I'm gonna go ahead and get rid of some of these target date labels. And so I can't afford a full property, but I could buy an investment fund that does buy property so that I can just buy a share of someone else's property. That's what it does. And so I'll leave everything else blank. I'll just get those 38 without, you could, get the search to be more strict. I could say ones that are headquartered in a certain area, ones that have some sort of price, ones that are managed by a certain kind of person. And you can see on here, there's a lot of different choices, but Vanguard Real Estate Index Fund is a pretty common, that's actually, it's priced in, the .mx means it's priced in Mexican pesos, which I'm going to ignore. So I'm going to do VNQ, which is the Real Estate Index Fund. And so for $93, I can get exposure to real estate rather than purchasing a full building, which would cost me hundreds of thousands of dollars, depending on what state it's in. And so this real estate fund is available for me to be able to get into real estate in my retirement account for cheaper. Now, I don't own the building, I own the investment, and this is Vanguard, which is a type of investment company. Vanguard is a pretty well-known one. You might have heard of Fidelity or TD Ameritrade or some of the other ones. Vanguard is just one of those big investment fund managers. And so they put together this portfolio. And if I go look at holdings over here, I can scroll down and I can see that it's in, this says stocks, but that might not really be true because it's real estate. And I scroll down here and I can see that what do they own? They own the real estate index, they own American Tower Corp, they own all these different types of investment companies. This is a storage unit, but that's okay, right? They own those kinds of things in order to have that real estate exposure. And so that's an option for my retirement account as well. If I go back here, I can see, so ETFs are pre-built portfolios. And so that real estate ETF that I just showed is a pre-built real estate portfolio, but those portfolios exist for everything you could possibly think of. It's an unlimited number of these things. There's ETFs built just for technology. There's ETFs built just for healthcare. There's ETFs built for commodities. Actually, one that I know of is GLD. Let's go look at GLD, and this is gold ETF. And so what it does is you can purchase, instead of having to buy physical gold bars and gold coins, you can buy GLD, which is an ETF that represents the value of gold. And so when gold prices go up, GLD goes up. When gold prices go down, GLD goes down. That's, again, not a recommendation. It's just an example of a type of ETF that tracks the value of something else to make it easier for you to purchase. And once you already have an investment account open, you can very easily go type in a search for any ETF you're looking for and purchase it through your broker. So one thing you do want to watch out for are fees. And let's go look at a couple. So MSEFX is one that I looked for just as an example of, let me see if it comes up here. MSEFX. Yeah. Oh, not DocuSign. Try that again. There we go. And then I just did a search earlier before this presentation to try to find a fund that had what I thought to be a higher expense ratio than some of the other ones that I've seen. I don't know anything about this company at all, and I don't know whether they are good or not. But I purely was only searching for an expense ratio higher than 1%. And this company has a fee, an annual fee to manage the fund of 1.23%. So in order to own this fund, you have to pay them annually 1.23%, and they manage a fund for you, and they hopefully will return more than 1.23% so that you make money in the long term after fees. And I don't know if they do that very well or not. I don't know anything about them. I'm not recommending them. But that's one choice. And this is equity fund, institutional class. So this is a managed fund. There's some investment manager who runs this fund and charges this 1.23% per year to manage it. And they have what's called a large blend, which means they're large companies, like big companies like S&P 500 and Dow Jones type companies, and a blend of growth and income type funds. So they'll have stocks. They'll have some stocks that pay dividends. They'll have some stocks that are technology type. They'll have some stocks that are, it's just a blend of a lot of different things, but they're all big stocks. That's their style of investing. And so they charge 1.23%. The lowest one I could find, again, not a recommendation, just the lowest fee that I could find for a managed fund is IVV, and that would be the iShares. iShares is a fund that's run by a company called BlackRock, and BlackRock runs iShares, and they have the S&P 500 ETF where all they do is manage this as if it were the S&P 500. And so they charge down here, the expense ratio for this means how much do they charge for running that fund is 0.03%. And so that in the finance world, we call 0.01% a basis point. And so this is 3 basis points to manage this fund. The other one would be 123 basis points to manage that other fund. And again, I'm not recommending or for or against any of these investments. I just wanted to show you 2 different funds that don't really do the same thing at all. This is the S&P 500, and the other one is a large cap blend, which may or may not be similar to the S&P 500, but they charge different amounts of money for fees to manage these. And you may have an investment manager for your retirement account who charges a fee as well. And one thing to think about, and this is something I always talk to my clients about when I was a financial planner, is that I charge a fee to manage investments, and the investments that I pick may charge their own fee as well. And so if your fund manager is charging you an annual fee to manage your investments, and the investments that they're putting in your portfolio also charge their own, you're paying all of those fees. And so be aware of that. Be aware of how much you're paying in order to have your funds managed. And I'm not, again, not recommending for or against anything, but sometimes it's worth it, sometimes it isn't. You just got to check for yourself to see what's the case for you. So here's a few examples. These are IVV is the first one on here, and MSEFX is that last one. VBK is another. That's a Vanguard small cap growth fund, and the same thing. And if I remember correctly, I believe their annual fee is 0.09%, which would be 9 basis points. And that one was just kind of in the middle in terms of expensiveness. So we usually quote percentage for an investment manager. We would quote as a percentage of AUM, assets under management. And so when your portfolio manager, your financial advisor is managing investments for you, they may say that they charge 1% AUM, which means they charge 1% of the amount of money that they manage for you, assets under management. And those assets are invested in these funds that then charge their own fees. And so you may be paying more than 1%. You may be paying 3 or 4 or even 5%, depending on the types of funds that your investment manager is putting money into. So be aware of that. And that's going to be one of the longer term, when you're investing for the long term, fees, annual fees are going to be one of the things that you're going to really want to be aware of, because it's going to slowly eat away at your wealth over a long period of time. You're going to be paying that every year for as long as somebody's managing your portfolio. Another thing to think about with your portfolio is what we call rebalancing. And so every so often, you want to look at the different investments that you have and see how they've performed. Because we're diversified, if we have a diversified portfolio, some of our investments may have gone up and others may have gone down. And so when I set up my target where I said, let's say I'm a little bit older and I have maybe 60% of my portfolio is in stocks and 40% of my portfolio is in bonds. And let's say that's where we are. And then over some amount of time, let's say it's been a couple of years, the stocks did well and went up in value, and the bonds didn't do that well. They just kind of stayed flat. Well, now that 60-40 that I targeted has become 70-30 because the stocks went up so much. And so now I'm looking at my portfolio and I say, hey, you know what? I have a lot more exposure to stocks than I really want to have because I'm older and I want more bond exposure. And so what we do is we rebalance our portfolio. What that means is the ones that have gone up and are worth more and have a larger piece of the pie than I want, we want to sell off some of those to kind of shrink that pie piece down and use the proceeds from that sale to purchase more of the smaller one. And so the bonds, we buy more bonds using the money that we received from selling the stocks to bring us back to that 60-40. And what that's called is rebalancing. So we bring our portfolio back to 60-40 where we want it to be. Or if it's been a number of years and I'm much older, maybe I want to be closer to 50-50 even. But I do that and I bring my portfolio back to where I want it to be. And then, sorry, there's a siren going on here. And so now the portfolio is back, let's say 60-40, it's back to 60-40. And then over time, maybe the stocks go up again. And so I sell some of those and use it to buy more bonds, or maybe the bonds go up. And so I sell some of those to buy more stocks. And I just do that every so often. For my clients, when I was a financial planner, I would rebalance their portfolio at least every 6 months. But I would check regularly to see where things are. Because sometimes, even if you set 6-month intervals to rebalance your portfolio every 6 months, sometimes things happen where you have a very large price movement all of a sudden that was just completely unexpected because of some news that happened in the world. And so you might need to rebalance more frequently than that, but every 6 months is plenty fine. Even every year is okay for a lot of people. So that's the long-term investing presentation. I hope that's been informative for you. The idea here, really, to kind of put it all together, is that we want to look at what are we going to have in our portfolio for the long term, for more than 10 years. And I want to have diversification, meaning I want to have exposure to different investments so that if any one of them goes down, the rest of them will still hopefully be okay. You end up with a 2008 scenario where everything goes down all at the same time. There's not really much you can do about that. So maybe cash might be a good option to have for a small part of your portfolio as well, just so that it doesn't go down, although inflation will hurt your cash position. So just some things to think about. For future workshops, some of the ones coming up will be inflation. So today, just coincidentally, today was the inflation number that came out at 8.6% that it came out today, which was higher than expected. The Federal Reserve has been increasing interest rates to try to stop the inflation, but it hasn't worked. So inflation is still really high and it's causing a lot of problems for our economy. So we'll do an in-depth look at inflation in one of our next workshops. Managing payroll, if you have employees and you want to figure out how to make sure that we can get them on payroll and make sure that or maybe you're just starting a business and you're looking to hire people, but you don't know how to do payroll, we'll look at that. I used to run a business where I had 15 employees, I think, at the peak. And I did all the payroll myself. So I will show you kind of how I did that and some ways that you might be able to do it. Also some other resources for how you might hire somebody to do it for you so that you can just kind of get it out of the way and move on. And then insurance topics will be the next one as well. So those will all be some of the financial planning workshops that we'll do, but you can see all of the topics, not just the financial planning topics. You can see all of them at the Butte County Library REACH program calendar, which you can see the URL for them right here. So I hope that's been useful. Please let me know if you have any questions, and thank you for watching.